Good morning, everybody. Today I'm trying to give you an accounting standards update specifically for the community housing sector, and our attendees are all within the community housing sector. I thought I'll highlight two specific areas at this stage. The one is the changes to the leasing standard, and specifically peppercorn leases, which I know I've often been asked about within the sector, and then also the new standard around revenue recognition or income recognition. So that's the two main areas that we'll be covering today. And there's another standard as well, a new financial instrument standard, but the focus today is on the two main ones for your sector, AASB 16 leases and AASB 1058 income of not-for-profit entities. So the outline of the session, I've broken it down into 5 specific sections. The first one, the new AASB 16 leases, including peppercorn leases. Then an introduction to the new revenue standards, because it's a combination of standards. I've also then moved on to the new AASB 15 revenue from contracts with customers, because in certain situations you could potentially fall within AASB 15. I would specifically look at when does AASB 15 apply to not-for-profit entities, and lastly, if AASB 15 does not apply to the not-for-profit entity, it will fall within AASB 1058, and what are the requirements of AASB 1058. So that's really what I'll be trying to do in our session today. Now, just a upfront disclaimer that this is training purposes. I haven't looked at any particular contracts or facts and circumstances surrounding your entities, but it's a general training exercise. So let's start with the new AASB 16 leases. Now, this new standard is really bringing the end of the road for operating leases how we currently know it. So the new AASB 16 introduces a single lessee model, accounting model, where all leases will be accounted for in a similar way to how we currently account for finance leases. So the change is only for lessees. Lessors will continue to account for finance leases and operating leases the way they currently account for them. However, for lessees, a big change. So if you're a lessee and you've determined that you've got a lease, you don't go any further to split it between a finance lease and an operating lease. You just treat all leases exactly the same way. And I thought the best way to illustrate this is to look at an example and then follow on from the example on what are the impact on bank covenants, on profit and loss, on EBITDA, etc. So in my basic example, I said, let's say entity A entered into a 3-year lease of an administration building with the following lease payments. So, and please note that they're payable at the beginning of each month. So it's $5,000 per month for the first 12 months, then $6,000 per month for the next 12 months, and $7,000 per month for the last 12 months. So it's a 3-year lease of a building. And let's say entity A's incremental borrowing rate is 10% per year. So the first option in the standard is actually to use the interest rate implicit in the lease. In my experience, there is no interest rate implicitly stated in most lease contracts. Therefore, you have to go to the second option, which is incremental borrowing rate. And I've just tried to keep it simple and say incremental borrowing rate is 10% per year. So really, incremental borrowing rate, if you had to go to the bank, borrow money in order to buy this building, what rate would you have to pay on that loan? So accounting treatment in terms of the current AASB 117 for this lease of a building, we would have said it's an operating lease because we're leasing the building for 3 years. The economic useful life of the building is 30 years. It's clearly an operating lease. And for operating leases, we would have worked out an even operating lease expense for every year. So we would have said, look at all our lease payments over the 3 years, and that adds up to the $216,000. An even expense over the 3 years would therefore be $72,000 per year. So irrespective of the cash flow, we'll have an even expense in our profit and loss. Going forward, the accounting treatment for under the new AASB 16 is we'll say it's a lease. Because it's a lease, we'll do an amortization table, similar to what we currently do for finance leases. Our opening balance would be the net present value of all future payments over the 3 years, and that net present value, we would say debit an asset and credit a liability. Now the asset is a right of use asset, and then obviously a liability. And then we'll do an amortization table and say, listen, we'll have cash lease payments over the 3 years. There would be an interest expense. There's a principal repayment. I didn't do it on a monthly basis. This is a summary of the total 36 months amortization table. So I just grouped them together to put it onto a slide. And what you'll see here is initially at the beginning of this lease, your interest expense is more than the interest expense at the end of the lease. So how does that turn into journals and turn into an impact on your profit and loss? So what I've tried to do here is to compare over the 3 years the current accounting treatment under AASB 117, so the even operating lease expense, and contrast it to the new IFRS 16, where you'll have in your statement of comprehensive income, you'll have an interest expense every year that would reduce over the 3 years, and you'll also have an amortization expense, because remember on day one we've said debit right of use asset credit liability, and that right of use asset will be amortized over the period of the lease, because we've got the right to use the building for 3 years, and over the 3 years it will be an even amortization expense. So we've got an even amortization expense over the 3 years, but we don't have an even interest expense over the 3 years. Therefore, at the beginning of a lease, particularly this situation, which is a fairly normal situation, the impact on your profit is going down, or profit is lower in year 1 than profit would be in year 3. So that's really some of the impacts, or an illustration of the impact on profit and loss. If you look at your statement of financial position, and this is an interesting one, the standard setters have told us all along, you're going to bring an asset and liability on your balance sheet on day 1. And the asset and liability usually would be an equal amount. I think the bit that was often overlooked is the fact that your right of use asset has to be presented and disclosed together with the underlying asset. So if you've got a right to use a building, that right of use asset, although a right of use asset is usually an intangible asset, because it's the right to use a building, the underlying asset is a building, this right of use asset will be disclosed with your other property, plant and equipment. It will be disclosed separately, but it will be part of property, plant and equipment. So you've got a right of use asset, which is disclosed in this case with property, plant and equipment. And now for the real important bit, and that is that right of use asset is a non-current asset. Property, plant and equipment, non-current asset. However, if you go on and you look at the lease liability, your lease liability, your capital repayment is smaller at the beginning than it is at the end. So your lease liability at the end of year 1 is exceeding your right of use asset, so it's not the same anymore, and that continues to be the case at the end of year 2 as well. At the end of year 3, obviously the asset is fully amortized, the liability is fully repaid. So a difference between the liability and the asset creeps in over the period of this lease. I think the more important thing, however, is that your lease liability has to be split between current liabilities and non-current liabilities. So if you look at the split between the two, your current liability would be the payments you expected to make within the next 12 months, and the rest is a non-current liability. So let's go back. Your right of use asset is a non-current asset. There's no change to current assets. However, your lease liability is split between a current liability and a non-current liability. So if you have any sensitivities, or if your bank covenants or KPIs are in any way linked to net current assets, there's a problem, because you've got no new current asset, but you've got a new current liability. So the statement on the financial position seems to be, we've got an asset and liability, but if you look a little bit further, it's a bit different. The other thing is, if you've got a lease and there's a rent-free period, let's say in the first 6 months, the situation is actually worse, because in the first 6 months you'll have an interest expense, and that interest expense would be debit interest expense, credit liability. So in your first 6 months, your liability is actually increasing because there's no cash flow, but there is interest, and your right of use asset is already being amortized because you're using the asset even in those first 6 months. So rent-free periods is particularly tricky when we go to IFRS 16. If you look at the statement of cash flows, so currently your operating lease payments will be an operating cash flow. Going forward, the capital repayment of the liability will definitely be a financing cash flow, and the interest component, you've got an accounting policy choice whether you want it as an operating cash flow or a financing cash flow. In my illustration, I've treated the interest as an operating cash flow and the capital as a financing cash flow. But again, you can see your cash flow is not changing, but where you disclose it within your cash flow statement is actually changing. Before we move on to the next slide, I think it's good to stop here and just reflect. I've looked at the impact on profit and loss, the impact on statement of financial position, the impact on statement of cash flows. But let's just think, what's the impact on profit and loss? So at the beginning of these leases, profit and loss will be lower than the profit and loss at the end of the lease, because there's a bigger interest expense at the beginning compared to the end. If you think about the impact of EBITDA, earnings before income tax, interest, income tax, depreciation, amortization, EBITDA is actually increasing, because currently you would deduct operating lease payments in order to calculate EBITDA. Going forward, EBITDA is before the interest and it's before the amortization. So once we adopt AASB 16 or IFRS 16, EBITDA will increase. The other thing is to think about what are your bank covenants and how will your bank covenants be impacted, especially if there's a covenant related to net current assets. Another one, when I speak to people, that comes to mind is your interest cover ratio, if that's an issue, or your gearing ratio. Obviously, those will be impacted. So that's just a general overview of AASB 16 and what it's doing to lessees, and that provides some background to peppercorn leases. Maybe before we move to the peppercorn leases, currently the structuring opportunity for a lessee is to structure a lease to look and feel and meet the requirements of an operating lease, because if it's an operating lease, it's an even expense and it's off balance sheet. It's only in the commitments note, and therefore you could try and structure leases to meet the requirements of an operating lease. And the standard setters didn't like that. They said, we don't want that structuring opportunity. We want all leases to just be accounted for the same way. However, I believe the new structuring opportunity is around whether we've got a lease or whether we've got a service contract. So if it's a lease, then obviously we have to do whatever we have to do in terms of AASB 16. But if we could argue it's a service, services are expensed over time. So this decision tree is in the standard, in application guidance, trying to help you to determine, do you actually have a lease or not? And if it's not a lease, it's usually a service arrangement. The example I'll give you is around delivery vehicles. So if you lease a specific delivery vehicle and you're going to use that delivery vehicle to make all your deliveries, and if the delivery vehicle is not being used, the delivery vehicle is kept at your warehouse, and you decide where to use it, how to use it, you use the delivery vehicle, nobody else uses the delivery vehicle. In that situation, it's a lease. Because if you look at this decision tree, there's an identified asset. You have the right to obtain substantially all the benefits from that asset throughout the period of use. And just see there, we focus on the period of use, not the economic useful life. So if I'm leasing it for 3 years and I'm getting substantially all of the benefits for the period of use, the 3 years, it's a lease. And also if the third block there, if I can direct how this asset is being used, I've got a lease. That is very different to a situation where you enter into an arrangement and the supplier will make available a delivery vehicle to you. They'll do all your deliveries. When the delivery vehicle is not being used, it will go back to their warehouse. If you use the delivery vehicles during the day, they could use that delivery vehicle to do deliveries for other people during the night, or if you use it for Monday to Friday, they could still use the vehicle on Saturdays and Sundays. So in that situation, you potentially, it might still be an identified asset, but usually they would say, we'll send a delivery vehicle. It doesn't really matter which one it is, there will be a delivery vehicle. You won't get substantially all of the benefits because other people is also using the vehicle, and you can't direct where the vehicle is going. The supplier is directing it. So in that situation, it's not a lease. It's instead a service. So I believe there's a little bit of structuring opportunity on whether you've got a lease or whether it's a service, but it will be a complex exercise. So just want to put that out there. And there's also 2 practical expedients, and that is, if you're a lessee and if you've got a lease, you are caught by IFRS 16 and you have to do what, you have to comply with the requirements of IFRS 16. However, there's 2 practical expedients where you say, and it's optional, you've got a choice, you can use these practical expedients or not. And the one is if you've got a short-term lease. So a short-term lease is a lease including options to renew that's less than 12 months. So the aim there is if I'm leasing a hotel room for 1 night or 2 nights or for a week, that's a short-term lease. I won't have an asset and liability for that. So I don't think it's envisaged if you lease an office building for 11 months and you've got an option to renew it for another 11 months and there's for over 3 years, the lease term is not just, it's not a short-term lease. So short-term leases, I think, it's got limited application maybe for that hotel room situation, or where you lease a vehicle when you're visiting another town or on holiday. And then the next one, which I think the ability to use it is greater, and that is where the underlying asset is of low value. And they give us guidance to say, even if you're leasing a second-hand asset, you look at the value of that asset new. I suppose that's just to get some consistency. And the other thing is you look at a single asset. So you look at, would the value of a single new asset be of low value? And if you say yes, then you can use this practical expedient. Now this is a little bit bizarre because if you've got an entity that leases 1,000 laptops, you don't look at the 1,000 laptops and say, is the 1,000 times $2,000, is that of low value? Clearly that's not of low value. You would instead look at the value of one individual new laptop, which let's say is $2,000. The $2,000 is low value, and therefore we can use the practical expedient for the lease of all 1,000 laptops. So they don't believe that materiality within an organization should be included. They would expect a small not-for-profit and BHP bulletin to reach the same conclusion around whether the lease of an underlying asset is of low value or not. The guidance they give around the number is in the basis for conclusion they're talking about. They're thinking an asset that has a value of less than 5,000 US dollars would be of low value. They're also saying a new car is not low value. So a lease of a car definitely is not low value. They're also saying they're more thinking about small office furniture and equipment, personal tablets, laptops. So that's low value. Let's move on to what would be of more interest to you. That was more an introduction around what's happening on leases, is peppercorn leases. Now this is really an amendment to AASB 16 specifically for not-for-profit entities, obviously not covered in the IFRS 16 because IFRS 16 is only looking at for-profit entities. So if you've got a not-for-profit entity, the AASB has made an amendment where it specifically says that where the lessee is a not-for-profit entity and the lease has significantly below market terms and conditions, and it's primarily or principally to enable the entity to further its objectives, that not-for-profit entity shall, so there's no choice, a not-for-profit entity that's got a lease that's significantly below market conditions, so the traditional peppercorn lease, you've got a lease for $1 a year for 30 years. How will the not-for-profit entity account for it? Because remember, AASB 16 is now saying debit a right of use asset, credit a liability. So debit the right of use asset, you measure the right of use asset at fair value. So in for-profit context, you would say debit the right of use asset as the net present value of future payments. So the net present value of the $1 over 30 years will be a small amount. However, they've decided that's not what we want for not-for-profits. We will debit the right of use asset at fair value on day one. And then we'll measure the lease liability at the present value of those lease payments that will be paid over the next 30 years. So we could potentially have an asset of a fair value of $2 million. We've got a liability of, let's say, $30. And then what do we do with the difference? Now the difference, you have to apply AASB 1058. And AASB 1058 we'll discuss very soon, which will talk about can you spread it over a period of time or whether it is recognized as income on day one. Now that depends on whether you've got enforceable rights and obligations and whether you've got sufficiently specific performance obligations. Now, often these peppercorn leases are not or do not include sufficiently specific performance obligations, and therefore I've said that it's potentially income on day one. So this is a big impact for not-for-profit entities. But when we look at AASB 1058, you'll realize that we'll have to do an analysis of these peppercorn leases, not around what this slide says. I mean, this is cast in stone, but more around whether you've got enforceable obligations, rights and obligations, whether you've got sufficiently specific performance obligations, and that's actually something that not-for-profits will have to do with all their grants and donations, funding arrangements. But we'll get to that in a second. So I just want to wrap up the leases. Peppercorn leases, if you have them, definitely should be on your radar to talk about. So if we look at an introduction to the new revenue standard, sorry, I've neglected to say, the new leases standard, as well as the new not-for-profit standards, coming come into mandatory application in Australia for years beginning on or after 1 January 2019. So for not-for-profits, the leases standard and the revenue standard has the same application date. It's not the case for for-profit entities, because for for-profit entities, leases is 1 January 2019 and the revenue standard is 1 January 2018, so a year earlier. But they can early adopt leases. So if you've got a 30 June year end, these new requirements for leases and revenue will impact you 30 June 2020. And if you've got a 31 December year end, we're talking 31 December 2019. So a bit of an introduction on the new revenue standards. So currently, you know, we've got an income recognition set of standards and model for not-for-profit entities that has really led to divergence in practice, great divergence in practice. AASB 1004 contributions really led to a lot of discussion and debate over the years, and that's why the AASB has finally, after I think about a 15-year project, issued the new AASB 1058. So currently, the first question is your entity a not-for-profit entity? Now, again, that's not an easy question always. You know, many definitions are for-profit, not-for-profit, and the new standard doesn't address that. But, you know, if you're a not-for-profit entity, your next question would have been, did the entity receive a non-reciprocal transfer? So if you didn't receive a non-reciprocal transfer, so it was a reciprocal transfer, you would apply the normal AASB 118, AASB 111 for revenue recognition and construction contracts. However, if you've received a non-reciprocal transfer, basically meaning you've received some kind of asset or cash donation and you didn't have to provide an equal response back to that entity, it would have been seen as a contribution. Now, there was a lot of divergence in practice around when a transfer is reciprocal and when a transfer is non-reciprocal, and that whole reciprocal non-reciprocal has been removed in the new standards. So it's quite clear if you're a not-for-profit entity, don't worry about reciprocal non-reciprocal. I think the other very important thing to note is that not-for-profit entities can under no circumstance apply the current AASB 120 for government grants. That is a specific for-profit standard. So currently, great divergence in practice, AASB 1004 quite confusing, and a lot of people didn't like the outcome. If you look at the new standards, not-for-profit entities could in certain situations apply AASB 15, and I'll give you a bit of an overview of AASB 15 very soon. I reckon a lot of not-for-profit entities would like to be able to apply AASB 15 because AASB 15 allows you to recognize revenue as you satisfy performance obligations. However, there's quite a few thresholds and two particular hurdles that a not-for-profit entity will have to jump before they can apply AASB 15. Then the AASB issued an amending standard or Australian implementation guidance for not-for-profit entities. It's currently sitting in AASB 2016-8. The intention is for those application guidance to form an appendix to AASB 15, but the AASB have not merged or compiled the two documents yet. So if you're looking for the not-for-profit guidance, in a few years' time it will be in an appendix to AASB 15, that's the intention. However, currently you'll have to go and look at AASB 2016 number 8. And then if you do not meet the requirements to apply AASB 15 as a not-for-profit entity, you have no choice as to apply AASB 1058, which is income of not-for-profit entities. Now, all three of those revenue standards, as well as the leases standard, are applicable for years beginning on or after 1 January 2019. So if you've got 31 December year ends, we're looking at 31 December 2019, or for June year ends 30 June 2020. Now you could ask, so Aletta, why are we talking about it now? A few reasons. I suppose a big reason for leases, I don't know if you've seen in the press, there's been some newspaper article in the Sydney Morning Herald on Monday, and also in the Australian Financial Review on Tuesday, around the expected changes of the new leasing standard and what it would do specifically to retailers and software companies, or people who have a lot of operating leases. Operating leases are usually a long term, so people are negotiating those now. And I suppose the big reason for all these standards is that these standards have to be applied retrospectively. And what that means is, let's look at the 31 December scenario, and I've done a bit of a timeline. If you have to apply the leases standard and the revenue standards for 31 December 2019, that will be your current year, and your comparative year will be 31 December 2018, and therefore the beginning of your comparative year is 1 January 2018. And today we're sitting in June 2017, so in about 6-7 months' time, we have to be ready, and our systems have to be ready to capture the information that we will need to prepare financial statements 2 years later. So I think that's why we're talking about it, and we're trying to help clients to get ready. The other reason is that regulators and users are asking boards and directors and companies, you know, what have you considered whether these new standards will impact your organization? Have you done an assessment? And you should start to disclose that assessment, because AASB 108 wants you to disclose, you know, we've got new issued standards, and how do you think they will impact your organization? So if leases, and peppercorn leases particularly, is going to have a big impact on your organization, we have to disclose that and communicate that to those charged with governance, etc. So that's why we're talking about it now. So before I look at when you qualify for AASB 15, I thought I'll give you a very high-level overview of AASB 15. And I think as we go through it, you'll start to see why I think not-for-profit entities would like to apply AASB 15. The question is, do they qualify? Can they jump the hurdles? So the new AASB 15 establishes a single and a comprehensive framework for recognition of revenue. So it replaces all the current revenue standards and interpretations, and there are quite a few, and it's just one standard. It's a lengthy standard. If you look at all the application guidance, etc., we're talking about around 350 pages, and that's excluding the not-for-profit stuff. The big thing is it introduces a new 5-step model on when do we recognize revenue and what amount. There's also a lot of new qualitative and quantitative disclosures, and there's a lot of application guidance around licenses, a right to repurchase assets, etc. So there's a lot of application guidance to clarify a number of problematic areas. I suppose the big thing with AASB 15 is that it says we recognize revenue to depict the transfer of promised goods and services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. So we recognize revenue based on expectation on the amount that we'll be entitled to in future. So the whole thing is they do not want us to recognize revenue at, let's say, $100 in a particular year if we realistically only expect to be able to receive and entitled to receive $90 in future. So they don't want us to overstate revenue and then in the next year have a impairment or an expense. They want us to say on day one, what amount do you expect to be entitled to. So a very simple example is, if you sell something for $100 and the invoice amount is $100, but you know that you offer a settlement discount of 10% if they pay you within 30 days. And if you've got past experience to say that people will pay you, or that a big part of your client base will be paying you within 30 days, then for that part of your client base that will be paying you within 30 days, your revenue should only be $90, because you only ever expect to receive $90. However, for the rest of your client base, where you expect them to pay you after the 30 days and they will therefore pay the $100, your revenue will only be $100. Your revenue will actually be the full $100. So you have to recognize revenue based on your expectation. And then also they say a customer is a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities, and it's in exchange for consideration. So it's all about ordinary activities, which is similar to what we currently have. The not-for-profit guidance addresses a customer. And, you know, let's say government, if government give you money to run an immunization program in the community, would government be the customer, or is the community the customer? And in the not-for-profit guidance, they specifically say, if the government is giving you money to do certain activities on their behalf, although you provide the service to the community, government is your customer, and that contract with government is the contract that we'll be looking at. So they clarify that, and that was part of the old debate around the reciprocal, non-reciprocal. So that's how they've addressed that. So how do we apply that core principle? There are 5 steps. So if you meet the requirements to apply AASB 15, your accounting policy would have to address these 5 steps. So first of all, we identify whether we've got a contract with a customer. If we've got a contract with a customer, there's a whole a big part of the standard around that. Then we have to identify our performance obligations, our separate performance obligations. So exactly what are our promises? And if we have 2 different promises, the one is to provide food to the homeless, and the other one is to provide counseling services, then it's 2 separate performance obligations. They are, and they're not interdependent, they are separate. So we've got 2 separate performance obligations. In your 3rd step, you determine your transaction price. So let's say they give us $100 to fulfill those 2 separate performance obligations. Then you have to allocate the transaction price over the 2 based on standalone selling prices, and you recognize your revenue when a performance obligation is satisfied. So if I've got separate performance obligations and I can measure specifically when I satisfy those performance obligations, you can recognize your revenue as you perform those performance obligations. Now again, within the not-for-profit context, this is difficult, and I'll talk about it very soon on, you know, do you have sufficiently specific performance obligations where you can measure progress over time in order to fall into the 5-step model. But that's the principle of AASB 15. So when does AASB 15 apply to not-for-profit entities? I suppose, remember, the big benefit of falling within AASB 15 is you will not recognize the money on day one as income. You would potentially recognize that income over the period that you satisfy your performance obligations. And that's the benefit, and I think a lot of not-for-profit entities would like to get to that position. So when does AASB 15 apply to not-for-profit entities? So I've prepared a diagram which is just a diagrammatic representation of what's included in the application guidance. Sorry, I've got this terrible cough and cold. It's cold in Melbourne. So the 2 hurdles are, number 1, does the transaction occur in a contract with a customer? So putting it differently, does the transaction occur in an agreement with another party that creates enforceable rights and obligations. So an agreement with another party, so government, we have an agreement with government. Does that agreement with government create enforceable rights and obligations? And we'll look at that in a bit more detail. If we say yes, the next hurdle is, does that contract include sufficiently specific performance obligations? So putting it differently, does the contract include promises by the entity to transfer goods or services to a customer? And remember, that customer doesn't have to be government. It could be the community. We're providing services to the community on behalf of government. So if there are sufficiently specific performance obligations, if you say yes to that as well, you can apply AASB 15. If you say no to either of those questions, you're within AASB 1058. So I just want to look at those two threshold questions because that's really critical. If you say yes to both of them, you know, what would happen is when you receive your money from government on a particular day, you'll say debit, cash, credit, or liability. And as you satisfy those sufficiently specific performance obligations, you will debit the liability and you will credit income. So to get to that position, let's call it a privileged position to apply AASB 15 within the not-for-profit sector, you know, how do we get there? How do we jump these hurdles? So let's start with sufficiently specific performance obligations. I mean, maybe just a quick talk about enforceable rights and obligations. Enforceable rights and obligations are around, government would say, if you do not perform as the way required, you have to repay the money, or there could be significant penalties. That could be enforceable rights and obligations. They specifically say, the standard provides a lot of examples in the discussion, they actually specifically say, if government says, if you don't do what you said you'll do, if you don't perform, we won't give you further funding, that's not an enforceable right and obligation. So they give you money, if you not do the right thing, you have to give the money back, that's an enforceable right and obligation. They give you money, if you're not doing the right thing, there's a significant penalty, and that's judgment. What is a significant penalty? You know, that would be an enforceable right and obligation. So enforceable right and obligation is there are compelling things that you would kind of force you to comply with these performance obligations. If you look at sufficiently specific performance obligations, now this can be a little bit tricky. Sufficiently specific performance obligations, and often there are a few issues around this, and in my discussions with not-for-profits, this is what they are a bit concerned about. Specifically saying that if a not-for-profit entity, you know, make a statement of intent to spend a transfer or a grant in a particular way, that statement of intent alone is generally not enough to create a performance obligation. So a statement of intent, or this is what we planned or intend to do with the money, it's not sufficiently specific. Some element of the contract will need to be enforceable, and past practice would need to support the customer expectation. So based on customary business practice, as you know, they'll enforce this. I suppose the interesting thing is the standard also says that if an entity has an ability to enforce, that you comply with performance obligations, so they've got that ability to take the money back, but based on past experience, they've never taken the money back. That doesn't mean you know, that should not be considered. It is all about enforceable obligation is if they've got the ability. It's not about their intent, it's about their ability. If they've got the ability to take the money back, it's an enforceable obligation, or an enforceable right and obligation. If we go on to A condition that a not-for-profit entity must transfer unspecified goods or services within a particular period of time does not in itself meet a sufficiently specific criterion. So, for example, if a not-for-profit entity may provide a number of services under its charter, such as counselling and housing to disadvantaged youth, and let's say the condition is that you have to provide the counselling and the housing to the disadvantaged youth for a period of 3 years, that is not a sufficiently specific performance obligation to apply AASB 15. And therefore, you would not be able to recognize the revenue over the 3 years. So those kind of general statements, not enough. Some not-for-profit entities have a single-purpose charter, such as to provide counselling services. That's all we do. We do provide counselling services. However, again, it is unlikely that an entity's charter or stated objectives would be specific enough to require recognition of contract liabilities under a contract, under a contract that provided the entity with a grant for a specified period of time. So again, you know, that's too general. So where entities receive a transfer to be used over a particular time period for specified services, such a transfer could meet this sufficiently specific. So over a period of time, but it has to be for specified services, and there has to be measurable specified services. So it's not an outright no, but you have to be careful on how you frame it and how specific you are. So for instance, an agreement may include a condition that the entity undertakes an acquittal process to demonstrate progress towards transferring goods or services. For example, the terms of an agreement may require the entity to report on progress towards specified or outputs or outcomes in an acquittal process. Now, such an acquittal process where we can measure progress may provide evidence of a promise to transfer goods or services that is sufficiently specific. It depends on requirements of the acquittal process and other facts. And an acquittal process may also enable a determination of progress. So you have to be very careful around sufficiently specific performance obligations. If you are saying that the entity and grant says, here is money and I want you to use this money to provide counselling services to disadvantaged youth, and it goes further and it says you have to provide 40 hours of counselling services for 52 weeks of the year to the disadvantaged youth, and if you don't do that, you'll have to repay the money. In that situation, it's very specific performance obligations, and you'll be able to measure how many hours of counselling have you provided in a particular week, for how many weeks, and therefore you would be, I think it would be sufficiently specific to fall within AASB 15, and therefore you would recognise your income as you provide the counselling services over the time period. So, you know, really important, if we go back to our decision tree, that you know, we'll be able to jump both hurdles. So we need enforceable rights and obligations, and we need sufficiently specific performance obligations before we can apply AASB 15. And then when we're in AASB 15, we apply the 5 steps, which means we recognize income as we perform on our promises or our performance obligations. Now, if you do not meet those hurdles, and a lot of not-for-profits don't meet those hurdles, you have to apply the new AASB 1058. So what does the new AASB 1058 says? So first of all, AASB 1058 applies to volunteer services or the receipt of volunteer services, and it also applies to transactions where the consideration to acquire an asset is significantly less than the fair value. So you receive an asset for free, or you receive cash for free, or you receive an asset that's worth $10,000 and you've only paid $1,000. And the reason that is happening, it is principally to enable a not-for-profit entity to further its objectives. So people are giving you money or assets and saying, listen, we want you to take this and advance your objectives of providing food, providing shelter, etc. So those are the two things within AASB 1058. If you look at volunteer services, and here I'm just looking at the private sector, the rules are different for the public sector. Public sector don't have the choice. They have to fair value volunteer services. But if you're in the private sector, if you receive volunteer services, the first issue is, can the fair value of the volunteer services be measured reliably? If you say no, then you don't have to recognize it. However, in most cases, you would be able to measure the fair value, potentially at cost or a great cost, but it can be done. And therefore, if you say yes, does the entity elect, so you've got an accounting policy choice, to recognize volunteer services? If you say no, obviously not recognized. If you say yes, you would recognize those volunteer services at fair value. Now, the interesting thing here is the volunteer services that you receive. So let's say people are working at a not-for-profit entity for free. That would lead to a debit of an expense, salaries and wages, a notional salary expense, and you would credit income. So we are saying we receive a volunteer service that is income at fair value, and we also have an expense. So it has no impact on profit or loss before tax, but it does gross up your income, gross up your expenses to reflect what it would cost to run that not-for-profit entity if you didn't use volunteers in the organization. So most not-for-profits that I speak to are not keen to go down this route, just because it's really hard to determine the fair value. They think it would be great cost. You know, there are issues on who are volunteers, who are not volunteers, how do we measure it, you know, and really concerned about that. I have come across a couple of not-for-profits that's actually considering this because they want to communicate to users the value that they get out of volunteers, and so that's on the income side. So that's the donation of time. And on the expense side, the actual expenses, so if we didn't have volunteers and we had to pay people, what would it cost to provide all our activities, etc., even in that space? So if we look to the other transactions, that would be transactions where we receive an asset and the fair value of the asset is considerably less than what we've paid for the asset, potentially for free even, and it's all about to enable us to further our objectives. Now here is a bit of a process. So we've created a step ABC to work through this process. You start with the asset side, step A. So once you receive the asset, whether it's cash or another asset, you account for that asset that you've received in accordance with normal Australian accounting standards. So if it's cash, it will be within the financial instrument standard. If it's property, plant and equipment, you'll apply a AASB 116. If it's an intangible asset, you'll apply AASB 138. And this is, for instance, for peppercorn leases, if you apply AASB 16 leases, on a peppercorn lease, you have to apply the requirement that you account for the underlying asset at fair value on day one. So you look at the asset side, you look at the accounting standards, you account for your assets. If it's cash, debit cash, fair value, which is a transaction price. Step B is where applicable and where possible, you account for the credit side in accordance with other Australian accounting standards. So it could be that the credit side is a liability. It could be that the credit side is a contribution by an owner. various possibilities. But where there is an Australian accounting standard, you would apply that. So if we apply AASB 16 leases, we would apply AASB 16 and determine that the credit is a lease liability, and the lease liability is the net present value of future payments. And then we get to what do we do with the balancing figure? So if there is a balancing figure, so the excess of A over B, so the excess of the fair value of the asset that you've received for a peppercorn lease over B, the net present value of your future payment, would be recognized immediately in profit or loss. I just have to clarify, in the credit side, part B, if you comply with the requirements of AASB 15, and you can apply AASB 15, in step B you would potentially say credit a liability in terms of AASB 15, and then there would be no excess and you don't have to put it immediately in profit and loss. However, to get to that position, you had to have enforceable rights and obligations and sufficiently specific performance obligations. Now, often peppercorn leases don't have that. They don't have sufficiently specific performance obligations, and therefore they will end in this third block where it's immediately in profit and loss. The other thing, or if we step through it a bit slower and look at each block individually, so how do we recognize for the asset, or how do we account for the asset we've received? The asset received is in, if the asset received is within the scope of AASB 1058, you know, for instance, cash, it's a financial asset under AASB 9. It could be a leased asset under AASB 16. It could be that we've received a donation of a property, that will be AASB 16, or an intangible asset. And the asset are initially recognized at its fair value, and that's also what those other standards determined. So what about the credit side? Again, we see whether there are applicable accounting standards that we could use. So it could be a contribution by an owner. So an owner has given money to the not-for-profit. So it's a contribution by an owner. It's part of equity. It could be that we've got a contract liability because we've got sufficiently specific performance obligations. We could have a lease liability. It could be a financial instrument. It could be a provision in terms of AASB 1 through 7. So a lot of judgment required on what bucket does the credit belong to. So we at first account for the asset, then we look for the appropriate bucket for the credit. If we cannot find an appropriate bucket for the credit, it goes immediately to profit and loss as income. Then also there is one big exception, and that's the last bullet point. When a financial asset, for instance cash, is received to acquire or construct a recognizable non-financial asset, for instance a building, and that building will be controlled by our not-for-profit entity, there are specific rules for them. All right, so you receive cash and you've been told that you have to use this cash to buy an asset to be controlled by the entity, or to construct an asset to be controlled by the not-for-profit entity. And we'll look at that in a second. So the normal principle, if it's not volunteer services, account for the asset like you would normally do, look for an appropriate credit. If there's not an appropriate credit, the balancing figure goes into profit and loss. So what if we do receive an asset? So there's a transfer of an asset to a not-for-profit entity, for example cash, that to enable the not-for-profit entity to acquire or construct a recognizable non-financial asset. And that's what we've just talked about, is that exception. So if you say, yes, that's what we're doing, you recognize the income. So you've received the cash, you recognize the income as the not-for-profit entity satisfies the obligations under the transfer. So we get the cash, and if we have to go and buy a property, we would recognize the income when we buy the property, because that's when we performed on our performance obligation. If we get the cash and we have to construct or build a property that we will eventually control, we will recognize the income over the period of construction based on measurable progress. So specifically for cash that you've received to buy an asset or construct an asset, we've got specific rules. I thought I'll look at one or two examples, and I know it's 12 o'clock. I do apologize, I'm running over time. I think I've got two examples. Is it only two? Yes, I've got two examples that I want to flag with you to give you an idea of what we're talking about. I do apologize for running over time. I must have been talking slower today than normal. If you look at example 2 of AASB 1058, by the way, AASB 15 and that application guidance for not-for-profits has a lot of examples for not-for-profits, and AASB 1058 has a number of examples. So I really believe the Australian Accounting Standards Board has done a great job to provide a lot of examples specifically for not-for-profit entities. So that would be a good place to look at. So let's look at example 2. So let's say a charity makes a contribution of $500,000 to establish a company, and that company will operate childcare centres. So there are no repayment terms to that contribution, so it's not as if it's a loan. We give you the $500,000. There are no goods or services to be provided to Charity P in return for the contribution. Company S is a company limited by guarantee, so they only have, member contributions of $10. But important is that Charity B controls the voting rights, and therefore in accordance with AASB 10, Charity P actually controls Company S and therefore would consolidate Company S. So you have a parent providing money to a subsidiary. Now in that, to do certain things, it's not a loan. How do we account for it? So the related amount of cash is obviously an asset, debit cash. Because the Charity P is a member or an owner of Company A, and that transfer is in its capacity as an owner, and there are no services required to be provided to the parent, your journal on day one is debit cash, credit equity, contributed capital. So important to see here, if an owner is providing money to an entity in their capacity as an owner or as a shareholder, and in this case a not-for-profit entity, an owner, it will be contributed capital. In another example, example 6A, they say Charity B receives a government grant of $2.4 million in May of year 6, which is refundable if the money is not spent in the period 1 July to 30 June. So the fact that it's refundable if not spent means we've got an enforceable right and obligation. So at least we jump the first hurdle to get into AASB 15. Now Charity B determines that the 2.4 million grant, and you have to spend it in a certain period of time. Now to spend it over a period of time isn't sufficiently specific performance obligation. Therefore, Charity B determines that that grant is an asset, so we debit an asset, and we control that asset, so it's within AASB 9. And the Charity B's agreement just states that the grantor should use the grant in accordance with their overall objectives. So here's the money, use the money in accordance with your overall objectives for a period of 12 months. The agreement doesn't say exactly what our obligations are, so therefore not sufficiently specific, and therefore on 31 May when we receive the cash, we have to say debit cash, credit income. So yes, the agreement is enforceable because it's refundable, but there are not sufficiently specific performance obligations, so it's an income on day one. If we look at an extension of that example, so a slight change, so in this situation, you still receive the money, but now it says Charity B, the last bullet point, Charity B has an agreement with the grantor that specifies that the grant must be spent providing crisis counselling services for a given number of hours per week for the entire year Charity B expects to fulfill its promise to provide the counselling services. So 1, it's enforceable, so it's refundable. 2, it's very specific. So you have to provide a certain number of counselling services per week for the whole year. Therefore, in May, when the charity receive the money, they will say debit, cash, credit, liability. And now, because they are within AASB 15, and now as they provide the counselling services, they would recognise the income and they would say debit, contract, liability, credit, revenue. So that's, the benefit of having sufficiently specific performance obligations, to have enforceable, refundable agreements, and therefore you get to the, let's call it the matching. If you've got any questions, could you please post them, email them to me? You have my details. Oh, it's not on here, but you would have received an email from me this morning, aletta.boshoff@bdo.com.au, or speak to your BDO representative, your partner. I've already made a few appointments to speak to a few people around looking at peppercorn leases. See whether the peppercorn leases have sufficiently specific performance obligations attached to them. And this is not an easy answer. We'll have to do a bit of work on it, or you'll have to do a bit of work on it. Please contact me or your BDO representative if you would like some assistance. It's 7 minutes past 12. I've gone over time. Thank you very much for joining me today. We will please keep a watch out on our BDO LinkedIn page, website, my LinkedIn page. We will continue to communicate through videos, through webinars, through very short technical updates, as we do more work and as we see more examples and as we have more discussions on the proposed accounting treatment. So thank you very much.